let's begin looking at Chapter 9 and looking at receivables. The term receivable refers to amounts due from individuals and companies. These are claims the company expects to collect in cash. The types of receivables include account receivables. These receivables are generated when we sell goods or services to customers on account. The other type is note receivables. These are claims for which formal instruments of credit is issued as proof of the debt. They typically require interest to be paid on the balance owed. So, in essence, a note is a formal signed agreement, whereas an account is typically a verbal agreement. In essence, a note typically will bear interest, whereas an account will not. Now, you can have an accounts that bear a late fee or a late penalty. For example, your power bill. It's an account receivable from you as the customer, but the power company can charge a late fee, and that's what that 1% is, only if you're late. It's not an actual interest, it's a late penalty. And then there are other types of receivables, and these are receivables that do not result from the sale of goods or services. They are typically outside the normal scope of the business and include items such as interest receivable, income tax refunds, advances to employees, dividends receivable on investments, etc. So there are other types of receivables. The primary, of course, is accounts and notes. But the other receivables do exist. Interest receivable is a big one. If you have a note receivable, odds are you're going to have interest that has accrued. So we've defined a receivable. Now, how do we handle the creation of a receivable in our accounting records? So again, let's start by looking at just accounts receivable. So the first few lectures will be only on accounts receivable, and then we'll switch gears and we will look at notes. Let's look at how we would record a few transactions as they're related to accounts receivable. So on June 1st, we sold merchandise to XY Company on account for $5,000, terms 210 and 30. Well, a couple of notes here. One, on account means we did not receive cash, and we also know it's on account because of credit terms. Now let's review credit terms. You did have this in the last class, but let's talk about it a little bit. Terms 210 in 30 means there's a 2% discount if our customer pays us within 10 days. Otherwise, the net is due in 30. Now that means nothing to us at the moment, but when we receive the payment from our client, then it will make a difference, quite possibly. So how would we record this June 1st entry? Well, first we would debit our accounts receivable. Accounts receivable, again, is something that is owed from the customer. We've sold them goods or performed a service. In this case, we sold merchandise, so we sold goods, and they owe us money. We expect to collect that money in cash. So we're going to debit accounts receivable. Now, post-reference, remember, post-reference is for when we post to the ledger. It is included here. We're actually not going to post these transactions. We're simply journaling. So this column is for reference. It will not be used in this example. Now we're debiting our accounts receivable for the full amount the customer owes us, the $5,000. Remember, the 2% does not come into play in this case until we physically do the collection. Now what are we going to credit? Well, we sold merchandise, so we have received revenue. So we're going to credit sales or sales revenue. And again, our credit will be $5,000. Now I want to remind everyone of good journal form. I expect everyone in this class to use proper journal form. Proper journal form is the debit goes first, just as we have it here, followed by the credit, and the credit is always indented. So notice how this appears. This is good journal form. I do deduct points if you do not use good journal form. And then you would leave, if we had another transaction to do, we would leave a blank line and then start the next transaction. Luckily, we're only looking at one here, but keep this in mind. Good journal form is important. All right, let's move on. June 3rd, XY Company returned 750 of the merchandise. So when we have a return here, we basically are going to reverse our sales entry with one slight difference. Remember, when we have a return of a sale, we track those returns and we call the account sales returns and allowances. Sales returns and allowances is a contra account. It reduces our sales. And again, we're debiting that account for the amount of the returned goods, 750. Now, what do we need to credit? Well, if our customer returns the goods, they no longer owe us. So we're going to credit their accounts receivable to reduce the amount they owe, 750. So we've looked at creating a receivable. We've looked at one possibility. Once a receivable is created, we may accept a return. A return reduces our receivable, reducing the amount that our customer actually owes us. Now let's move to June 9th. Now on June 9th, we collected the amount due from XY company from the June 1st sale. So this is one possibility with a receivable. Once we have sold the goods, we can either accept a return and reduce the receivable, or we can show the collection of the receivable where our customer has physically paid us. Well, let's talk about that. What happens when we receive the payment? Well, our company is actually gaining cash. We're receiving a payment. Our cash is going up. How do we take cash up? We debit the account. So we're going to debit our cash account, showing that increase in cash, and we're going to debit for the amount that we received. Now, here's where we have to be careful. Notice those credit terms, 2% if paid within 10 days. Are we within the 10-day window? Correct. We are within the 10-day window, so we need to take into account that we will not receive the full amount due. We have to reduce it by the discount. So how much in discount and how much will we receive? Well, remember our client purchased 5,000. We do not get the discount on the full, or we do not give the discount on the full 5,000 because our customer returned 750. So at the moment, our accounts receivable is only 4,250 for this client. That's the amount that they would get the discount on. So in order to find the discount, we'd take the amount owed and we'd multiply that by the 2%. And when we did that, we would end up with an $85 discount. So we're giving $85 of discount to our customer. So how much cash are we going to receive? Well, they owed us 4,250. We've given them a 2% discount, which equals $85. So that leaves us with a collection of $4,165. So that is the amount of cash that we are going to receive. All right. Now, how much do we need to reduce the receivable by? Well, keep in mind they did get the discount, but we have a balance sitting in that receivable of 4,250. We have to fully wipe out their account. We have to zero out that customer's account because even though they got a discount, they do not owe us that $85. So that leaves us a break of $85. Where will that go? Well, we need a debit of 85 to make us balance. Remember, debits must always equal credits. Any ideas where we would put this? Well, from your prior class, you know that you would put this in sales discounts. And again, sales discounts, just like sales returns and allowances, is a contra account. It's a contra revenue account. It reduces our total revenues. So in essence, we made 4,165 in sales. We had 5,000 in original sale, right? Minus the return of 750 brought us down to 4,250 in net revenues, minus the 85. So that brings us down to 4,165 in net sales. We calculate net sales by taking the sales revenue minus any sales returns minus any sales discounts. All right, let's move on. The next thing we need to look at is a possibility of credit card purchases. So what we just looked at was an example of account receivable and collecting the amount, but what do we do if our customer comes in with a credit card? Well, the answer to that all depends on the type of credit card we're dealing with. So if the customer comes in and uses a national credit card, say a Visa or MasterCard that's a bank-sponsored card, then our company records this as a cash sale. To us, we are not responsible for the collection if it is a national brand credit card. It's actually the credit card companies that are responsible for the collection, or the bank sponsoring the credit card company. So when they use a national brand like Visa or MasterCard, we simply record it as cash. So when you go down to Target or Walmart and you go in and you use your founder's credit card, for example, that's actually a cash transaction to Target and to Walmart. They do not see that as a receivable because they are not responsible for any of the collection activity. The bank will simply settle and send them their money periodically. Typically, they settle. Sometimes it's twice a week. Depending on the size of the account, it could vary. Now, on the other hand, if it's a store credit card, and we have to be careful here because not all store credit cards are store credit cards. For example, if you go into Best Buy and you get a Best Buy store credit card, that's actually sponsored by an outside bank. So, again, Best Buy is not responsible for those collections. It's a Visa or MasterCard sponsored by Capital One or another banking company. Those are cash transactions to Best Buy. Now, Kohl's, though, on the other hand, Kohl's is an actual Kohl's account. It is sponsored by Kohl's, and Kohl's is responsible for the collection of the Kohl's credit card. In that case, if the customer uses a store credit card, then the company records the debit to accounts receivable, as the store is responsible for the collection of the receivable. So notice the difference there. You have to be very careful. So let's look at some examples. On June 10th, our company, Flank Incorporated, sold merchandise for $2,500 to XY Company and accepted the customer's Juno Bank MasterCard. Now, right off the bat, we know that this is Juno Bank MasterCard. This is a national card sponsored by a bank. Therefore, Flank is not responsible for the collection. However, if they do use a national card, usually we have to pay a service fee. So MasterCard, charges a 2% service charge for credit card sales. How would we record this transaction? Well, first we'd start with our date. Now let's talk about what we know. We know we sold merchandise, and anytime we sell merchandise, we record sales revenue. It's a revenue for our company. We're gaining profit here. Is a revenue account a debit or a credit? Well, hopefully you remember that revenue accounts are credit accounts. So I'm going to skip down here and go ahead and put in my credit so we can back into everything so you can see it. Now, how much in sales revenue do we recognize? Well, we physically sold 2,500, so that's the amount of revenue we're going to recognize. Now, we said that if it is a national brand card, like MasterCard or Visa that's sponsored by a bank, we record it as a a cash transaction. Now, when we're looking at this, cash would be going up or down. Correct, it'd be going up, and to take cash up in our accounting world, we debit the account, so cash is going up. But we have to ask ourselves, how much cash are we physically going to receive? Well, remember, we have to pay that 2%. So the bank is actually going to take the 2% before we receive the cash distribution. So 2% of 2,500 is $50. So the bank's going to charge us $50, which means they're going to settle the account at $2,450. Now, does that $50 just get lost? Well, to us it gets lost, but remember, debits must equal credits, so we have to record it. And in this case, it's simply just a service charge or service charge expense account. Okay, so keep in mind when we do use a national brand, we do record it as cash, but we do have to take into account the fact that they're going to charge us a fee before. So before they send us our settlement, they're going to go ahead and back out their 2%. So even though it's 2,500, they're going to back out 2%. They're only going to send us a check for 2,450, or actually it's an electronic transfer at this point. All right, so we've looked at the possibility. Oh, here's another transaction. Hold on one second. I almost missed this last one. On March 28th, our company Flank sold merchandise for $800 to a customer who used their Flank Inc. credit card. Now notice the difference here. This is truly a store-sponsored card. This is a Flank credit card, which means Flank would be responsible for collection. The customer paid $400 on April 15th. On April 28th, Flank Inc. charged 2% interest on the outstanding balance. The cool thing, if we sponsor the card, we can also charge the interest on the card. So a lot of times you'll see higher interest rates on some of those cards. How do we record the transactions related to the sale? Well, let's start with March 28th when we actually did the sale. Since this is a store-sponsored card, the store would actually record this as accounts receivable. We are recording it from this customer in which we sponsored it, and this was $800. And likewise, we get to record sales revenue. Now, since we're the sponsor, we do not actually have to pay any service fees on it. We're responsible for the collection and the settlement, etc. So there's no service fees typically associated. Now, on April 15th, our customer sent us payment, so that's a good thing. They sent us a payment of $400. Now, that's not the full balance due, but it is partial payment. So when we receive payment, what would we debit? Well, when you receive payment, you're receiving cash. Cash is going up, so we need to debit our cash. Then what do we need to credit? Well, the customer at this point is paying down their receivable. So we've received part of their payment. They no longer owe us that $400, so we need to reduce their account by $400. So that's all the payments we received from the customer so far, and then a month has passed and April 28th rolls around. Now on April 28th, we bill the client again. We send out an invoice, but we need to reflect that, hey, you've had this outstanding balance. After the first grace period, we start charging interest. We are charging 2% interest per month on this account. So the first thing we have to look at and see is how much interest do we need to accrue. Well, the customer owes us $800, that's in their account, but then they paid us $400 of that. So that left us with a total of $400 outstanding balance. Now, that $400 is already sitting in the receivable accounts. However, because it's sitting there, we get to charge that customer 2% interest per our credit agreement with the customer. So we need to take that 400, we're going to multiply it by the 2%, and that gives us a total of an $8 fee. All right, so how do we record this? Well, this fee goes straight into the customer's account. All right, this is a service charge, so to speak. It's interest on that customer's account because they did not pay the full balance within 30 days or ever how long your company's grace period is. So we put it right into that customer's account for $8. Now, what do we record in addition to? Well, it's not sales revenue because the sales was $800 to start with, but it is interest revenue. So we're going to record this as interest revenue to our company. Please keep in mind, a lot of people want to record $408 here. The $400 is already sitting in the receivable. The only thing you need to record at this point is just the surcharge, the interest charge that you're billing the customer for, in addition to their already outstanding balance that they know about. Okay? All right, that concludes our introduction to accounts receivable and just a short view of what the accounts receivable creation and collection look like.